Welcome to the Business Trendsetter podcast, where we talk about trends and how to use them to grow your business. My name is Manny Turan.
I'm Adam Hartung.
And of course, we are Spark Partners. Thank you for being part of our podcast here. I want to talk about one of my favorite stories, and I know it's one of yours as well, and that's the everlasting darling that is Netflix. We've talked about them quite a bit as a company who has really focused and continue to focus on their value, which is to deliver entertainment, even though their value delivery has changed from delivering DVDs via the mail to delivering streaming, then to delivering new content. So I want to take that topic in light of some recent news, Adam, and get your thoughts on it.
Okay. So once again, I want everybody on this podcast that listens or watches to know that Manny and I do not recommend buying or selling of stocks. We are not financial advisors. We are not stock pickers. We are not licensed in that field. We talk about companies. And when we talk about their valuation, it's a reflection of what the market thinks. That said, last Friday, Netflix stock fell out of bed. They lost $50 billion in market cap in one day, 21% of its value on that day, which was reminiscent of what happened to Facebook a couple of months ago, I think it was, when they had a really dark day. And the issues were related again to expectations and where investors get their expectations. And when Facebook dropped in value, that was because they said that the daily active user number was not growing at the rate that it had grown. It was a slower rate of growth, and its monthly active users were not growing, and the people ran away from the stock in droves. And it was something similar with Netflix, and that they said that net new subscriber number for the current quarter wasn't going to be up to specification. Now, here, make sure we get this timing again. They had this discussion with all the investors and analysts, but they were talking about the holiday quarter. In other words, the fourth quarter of 2021. And so that went well. I mean, the numbers, we'll talk about that tomorrow, were good. But just they brought out, they said, well, next quarter, we're going to come and talk about the first quarter of 2022. And by the way, we think that our net subscribers are going to be, a net increase of about 2 million, I think is what they said. And the market just went, oh my gosh, that's horrible. That's terrible. You're not getting enough new subscribers, and so therefore we're going to slaughter you. So now, let me just put the frame of reference around this. The first thing I want to point out is that when you talk about percentages with stocks, remember your base is always changing. So if the stock's going up and then you say it went up 6%, well, that was off the last number, so it goes up. The same thing happens when you go down. So I said the stock was down 21% on Friday. But what I really would like people to kind of keep in mind was that in November of 2021, Netflix was $700 a share. And now it's trading at $370 a share. So it's almost lost half of its value at the peak. That is an enormous, it's far worse than the 50 billion that I talked about. We're talking about a much, much bigger number than 50 billion, down a half. And so you would say, wow, that a half of its value, was it wildly overpriced at $700, or is it perhaps underpriced at $370? Thinking about the long-term value of the company. Yeah. So there's some things, I think we can look at some numbers that make a difference. So they said they projected for the next quarter, for the first quarter, which is, by the way, complete now and in the books. So they're giving a projection for history, crazy as that sound. They thought it would be about half the analysts' expectations. And they talked a little bit about competition, and they said, well, there's more competition than there used to be before. And the analysts put those two things together and said, okay, the competition is eating up Netflix. But I want to go back to this. My whole thing is, are you in a growth stall, right?
Right.
And we measure growth stalls on revenues. That's most important. You can also catch a growth stall through earnings, but because earnings can be manipulated, it's less reliable than revenues. Revenues are the better way. So growth stall is 2 consecutive quarters of declining revenues.
Right.
Or if you've got seasonality, then it's 2 quarters compared to a year ago. So, they might go down, but the down's okay because of seasonality, so we're comparing it to a year ago. And there is enough seasonality in Netflix that we tend to compare it to the previous year. If we get into a growth stall, you got about a 38% chance that you're going to go into the pooper pretty quick. And then you got a 25% chance. Then you got about a 35% chance that you're going to stumble around, but you're going to phase yourself out within a few years. And then you got, so we're now at 35 and 25, we're at 60%. Then you've got about a 35% chance that you're just going to stumble and do kind of like General Motors from 1960 to the year 2000 or 1995. Right. Just like it doesn't matter. The stock never goes up. It's just terrible.
It's stagnant almost.
Yeah, very stagnant. That's about another 25%. You got about a 10% chance that you'll regain growth. So the point here is you don't want to hit a growth stall. A growth stall really indicates, oh my gosh, something's happening. People are taking their money elsewhere. They're not spending money. And so we have to start saying, is Netflix in a growth stall? Now, remember, when I did the numbers on Facebook, I was able to demonstrate that they were far from a growth stall. Their numbers were all up. They were consecutively going up in terms of revenue, and that the thing to look at was the revenue per user. So the daily active users may not have been growing, but the revenue per user was had gone up tenfold over the last decade and was continuing to grow every quarter. And therefore, I was very optimistic, and I still, to this day, remain optimistic about Facebook. And that's what I want to dig in on Netflix.
Okay.
Is that, they did add 2.5 million new subscribers in the first quarter. They confirmed that. So we don't have a decline in users. It's just not what it used to be. So if we take, for example, in 2021, they added 18 million new users, 18 million, and that was about a 9% increase in their base. Now they're up to around 220 million users, and they're saying they're going to add 2. So it's a 1% increase on a very big number, 220 million users.
That's a lot of people.
Yeah, so they're continuing to grow at 1%. So we're not a stall. We don't have a negative number. If we had a negative number, we'd say, oh, that's bad. Let's look at the future. But again, this is users. This isn't revenues. So we have to go take a look at revenues. And this quarter, the holiday quarter, they had revenues of $7.7 billion. The previous year, revenues were $6.6 billion. So that's a $1.1 billion increase in revenues in the quarter, a 16.7% increase. So again, no indication of a revenue stall here.
That's not a bad number at all.
Yeah. Now again, I don't like earnings because earnings can be manipulated in terms of when do you account for your revenues, when do you account for your costs, and you can do all kinds of things to smooth out earnings. But the earnings were $1.33 per share versus $1.19 per share last year. So their earnings were up 12%. And get this, the earnings at $1.33, the analyst expectations were 83 cents. So they were way ahead of analyst expectations in the holiday quarter. So we're saying the fourth quarter, holiday quarter of last year was really good. And we've got the revenues going up there. So let's go back again and talk about what's happening, with cancellations. And the truth is that in the fourth quarter and the first quarter, the number of cancellations went down. So you got net new, that's the number I keep talking about, net new, which is new minus cancellations. Right now, we've got fewer cancellations happening. What does that say? People are sticking around. They're paying the monthly fees. And remember, they went through a price increase in 2020, and now they're talking about another price increase. So, well, not talking about, I think they've committed that they're going to do another price increase. So what that indicates is, again, more revenue per user. Revenues are going up again. And people aren't being driven away by the pricing. We have that information. Now, the second part is they're not being driven away by the pricing, but they're also not being driven away by the competition. So in the last 2 years, we've had Disney Plus come out. We've got Amazon getting bigger and stronger. Apple is getting more content out there. I don't know if you care. I don't watch the Oscars. But I learned this morning that the movie Coda won the Oscar, the Academy Award for Best Picture, and it was made by Apple. Yeah. And so for years, Netflix in this Oscars, I was looking, they had the most awards. I mean, they were nominated the most of anybody out there. Yeah. And apparently a lot of folks thought they were a shoe-in at Netflix to win the Academy Award for a Western movie that they had up. The name escapes me now. But they didn't win it. And so there was a little bit of this, oh my gosh, everything's going wrong with Netflix because they didn't win the Academy Award. And so it's all going to go to Apple, and it's going to go to Disney, and it's going to go to HBO Max, and that's where the market is headed. But what we have to keep in mind is that we don't have a fixed field. In other words, the amount of entertainment that's consumed is going up, right?
Yep.
Let's think about in retail, for example. Amazon comes along. Amazon grew the market of retail. More money was spent in retail. And that's a much bigger market than entertainment, so it grows at a much slower rate. But, a part of Amazon's growth in the early years especially was just creating new sales, people buying stuff online that they couldn't find in a store. They couldn't go find the books they wanted, and Amazon was bringing them the books in the early days and other merchandise, so they grew the field. So that's what's happening now in entertainment. Is that the fact that people aren't canceling tells us that they're keeping their Netflix account and then they're adding on to it. They're buying, the Amazon Prime. They're buying into the Apple movies. So the whole market, the balloon is getting bigger. So that allows everybody to go get bigger. Now Netflix's share is getting smaller. But it's not because they're getting smaller. It's because the balloon is getting bigger. And as the balloon gets bigger, the new content's getting added into it. But what do you suppose of all the purchased video out there? I'm talking all the purchased video, all the platforms. What do you think Netflix market share would be for all these platforms globally?
Third.
Yeah, it's 45%. So that's what I want to help people keep in mind. It's down. A couple years ago, it was 55%. So it's now 45%. But that's because the balloon keeps getting
bigger, right?
Yeah, the balloon keeps getting bigger. So but then I want you to think about that 45% of the entire market of purchased entertainment is this one company, Netflix.
It's massive. It's giant. Oh. It's crazy.
And it tells you that they're still way out in front. They're still way out. They're still the lead dog by a lot.
So why do these analysts sound this crazy alarm? I mean, why did it drop so much then?
Well, you see, again, I'm not an analyst, but what you pay attention to when you read what analysts have to say, they'll talk about growth of users, right? And they'll get some kind of a metric like that, net new users in this case. In Facebook's case, it was the monthly active users and daily active users, MAU and DAUs as they call them. And they get fixated on that. And when they start seeing anything that looks like there might be trouble in adding new customers, then they have a tendency to run for the hills. Now, again, personally, I always say I'm not a trader. I wouldn't want to be a trader.
Right.
In fact, there's some other interesting statistics that have come out recently. So there's a whole world of people that pick stocks, right? And they'll have a mutual fund, or they'll have some way that you can invest with them, and they're stock pickers. And they'll say, well, I'm a stock picker for the pharmaceutical industry, or I'm a stock picker overall. And so those are a class of investor that you can invest with. Then there's another way you can invest, which is if I'm saying now you don't want to pick your own stocks. You don't want to pick your own stocks.
Right.
So one way is you go to a stock picker. The second way is you would just go buy what's called an exchange-traded fund, or an ETF. Then you could get the S&P 500. They're called spiders, for example. Or you could get the Dow Jones Industrial Average. Those are called diamonds. But they're traded every minute on the stock exchange. And so you can just go buy them like a stock. You can buy the Dow, or you could buy a spider. So they did a study looking at the last 10 years. And they looked at the last year, and the results just came out on Market Watch in the last few days. So the stock pickers, all they do is spend their whole lives picking stocks. So they should do better than the average, you would think, right?
You'd think, of course.
So kind of just take a guess. What percentage of them do you think beat the stock market last year, and what percentage have beat the stock market over the last decade?
I would hope that because they do this for a living, it's substantially higher. But I'm going to kind of temper that and say 20%.
Yeah, 9.
Yeah.
9. That means 91% of stock pickers did worse than had you bought the Dow Jones Industrial Average Diamond, or you bought the Spider 500. Okay? So right off the get-go, it should tell you being a stock picker is something you got to be careful about.
So
right?
Those odds, by the way, are very similar to the odds of startups. When venture capitalists invest in a
that's right.
startup, it's about 10%, the ones that are actually worth anything.
Now,
The other 90 are crap.
I'm a very different kind of a guy. I think that's okay to own some ETFs, but I think in the parlance of stock trading, they say you can add alpha. That's the term that's used, meaning you want to try to get a little better than the average. So you could have your ETF, but then you buy just a few stocks that you would say, I think these few would outperform the market. And of course, that's where I go, and I always talk about the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, and it's fair probably to add Tesla into that group. And what happens is those stocks have done better than the averages by quite a bit. So if you've added alpha or put those stocks in, you've done better than the stock market. But that's not a stock picker. A stock picker will say, well, I think this year biotech's going to do good, and I'll start there. They'll start with some category, and then they work from the overall economy to the category to the stocks themselves, and then they buy and sell. And the reason I've done go this whole conversation is whether or not it was Netflix overvalued in November, and or is it undervalued today? And you said, well, what are they looking at? And that's what I troubles me a lot, is these stock pickers often put way too much thought into something like one number like net new subscribers.
Yeah.
And then they're masters at creating just really complicated spreadsheets where they try to figure out the future value of the company. The reality is, though, and I've looked at a few thousand of those guys over the last 40 years, what's important isn't the spreadsheet and how they construct them. What's important are the assumptions in them, and how do they arrive at those assumptions. And there are assumptions about everything, like the size of the economy, inflation rate, market size, price per unit sold, all kinds of assumptions they throw into this thing. And what I find it just be, just a waste of time. I glaze over when I look at that stuff, and so my performance has been based upon how are revenues? How are revenues going? So the one I always liked was, through 10, 15 years ago, you could look at the revenues for Ford, General Motors, Chrysler, and you would say, oh, these are pretty flat. They're not doing that much. It was true for Toyota and Honda. You couldn't get excited about that. But Tesla's revenues were going up. The second thing was that revenues, the stock prices and the revenues for those other big companies were stagnant. Tesla was going up, but Tesla also sold 100% of whatever it made. And that isn't true for the other car companies. They would make cars, they would eventually sell them all, but they would have to do so through gimmicks like putting them on sale. They would push cars out to the rental people like Hertz and Avis and National. They push them out at low rates, and then those guys, they turn around and sell them as a used car. So that's a good way to get rid of cars at a low price so that you can keep your inventory churning and keep pushing them into the marketplace. But Tesla was selling 100% of its products. Revenues are going up, selling 100% of everything they make. Things are going well. Hey, that's a good company. That's somebody you want to be supportive of. That's still true of them today. And that's when I look at Netflix. Netflix is still putting out all kinds of content. It's still doing well. Its revenues are growing, growing up at 16% per year last year. And what we haven't even talked about is the fact that, what was it, 6 months ago that I started talking about their entry into gaming?
Yeah.
So we haven't even gone through that.
Yeah, exactly. I think people... to kind of go back to the constant drumbeat at Spark Partners, which is to really look at trends and look at how massive they are in really creating a long-term business. Netflix is still on a major trend, and they're actually the trendsetter in many instances, right?
Yep.
A giant behemoth like Netflix walking into the electronic gaming space is going to be game-changing.
Yeah. It was Netflix that got us all used to watching movies at home, right? They won the war. Let's put it that way. We got started watching movies at home because we got the video machines and the VHS tapes and all that, and Blockbuster rose to eminence as the biggest of those. But it was Netflix that, was the David that took down the Goliath Blockbuster and got us used to just, ordering our videos at home. And then what did they do? They dramatically increased that at-home consumption by streaming. right? They
Yep.
changed the technology base to streaming. And then after we got used to streaming all this stuff, and it looked like we had an insatiable desire for this entertainment, they opened their own studio and they started making their own content,
Yep.
right? Now, each of those steps cost them money. Each time they did that, they raised prices because they needed revenue in order to make the transition. But it worked out well. And then 6 months ago, they said that we're going to get into gaming and we're going to make it a big part of our future business. And there's no discussion on Friday or over the weekend or today. I didn't see anybody talking about, well, what's the future revenues of gaming going to be?
Right.
How big a market will that be compared to static consumption of movies, TV type shows, syndicated programming? I have a feeling it could be a lot bigger. When I look, and I say that because you and I have tracked gaming for a long time, and gaming sales have been growing just incredibly fast.
Astronomical rate. Yeah.
Yeah, and we've got an aging population, and the young people are far less into static entertainment than dynamic or interactive entertainment, right?
Yep.
So. And then your revenue numbers have a whole new way of growing because you can be in a game and buy information and buy ways to improve your performance in the game. So that in-app purchase opportunity is going to be real there. So we haven't even seen it yet. We haven't even seen what they're going to do yet. They've only announced it 6 months ago, and they're still the traditional business is growing. The content is growing. The number of new shows coming out is growing. They're still the number one producer of content. They're not as their user base is spending more money with them. The competition is coming in, but it's growing the market more than it's stealing their share. Right? It's increasing the markets. We were buying Netflix and buying something else, which is good. And now we've got gaming coming along. So,
well, I think what's happened is, the loser here, of course, is our dear old tired friend, the movie theater, right? They're on the ropes. They're, they got that metal icing on their eye. I mean, they're going down soon, right? And by the way, I love the theater. I love the popcorn. I love the experience, but it's nowhere near what it was before. And we all know that. But one thing I thought about when you were saying this, Adam, that might be an interesting thing for our listeners and viewers to really think about is if you're interested in where the market's going in many instances, as it pertains to entertainment, look at what the 15 to 25-year-olds are doing. I think that demographic, my sons are 14 and 15, and they are obsessed with games. They will, I don't know if you know this, I might have told you this in the past, but they will be playing a game on their PC while at the same time listening to a guy on YouTube, play the same game, while at the same time on their other screen chatting with buddies on Discord, and this is all happening all at the same time. Yeah. That's the immersive experience that they're actually involved in. They like movies too, but that's really where the growth is, in my opinion, in the next 20 years.
Oh, I think no doubt about it. Gamification has proven to grow revenues for almost anybody who's moved that direction. A simple example is just take a look at the two most popular cooking channels, Food Network and the Cooking Channel, and they're owned by the same company. I believe they're owned by the same company. Years ago, when you turned on the Food Channel, what did you expected to have Emerald teach you how to do something, right? Or one of these other famous people, TV personalities would come on and, hey, we're going to make up this dish tonight. And Emerald got famous for putting a little spice in it and you go bam, and
bam.
And so what was once, you had a cook, had a stove, then he had a live audience and he had musicians playing, and it was becoming a whole theatrical entertainment. When you go to those channels now, they are almost all games. It's Beat Bobby Flay. Yeah, it's some kind of a competition. It's Chopped.
Iron Chef and such.
Yeah, right? Iron Chef. And it's a chronic drumbeat like that of these shows where people are cooking, but they're cooking in a competition. That's gamification. It's taking what was previously a static show about I'm going to teach you how to make pot roast and saying, okay, now here's a game that these people are participating in. Now, the next level of gamification would be for the user experience, right? So today you've got the Cooking Channel. One of these shows is called Chopped that's on there, and people get a basket of ingredients and they have to invent a dish in like 20 or 30 minutes out of the basket of ingredients. Well, the next level is going to be that I get to pick what goes in the basket. You know, they put on something on the screen and they'll say, hey, here's 20 elements. The top 4 are going to go in the basket. Vote for 4.
Oh, yeah.
And then
I say this all the time, and you know, it's much to the chagrin of all the people that are not The Rock. But Dwayne The Rock Johnson may be the last mega superstar that we have. Right? From now forward, it's going to be, instead of one mega superstar, for every one Harrison Ford or whomever, Robert Downey Jr., there's going to be 10 or 20 or 50 micro or 100 micro famous people, right? You see people that are local celebrities here in Tucson, and I'm sure in your neck of the woods, that might have a social media following of 1 million people.
Oh, yeah. And to prove that, I just look at TikTok and Instagram, where we see these top people that get huge audiences. Again, it's not a market in which I participate, but I do observe, and there's people making a lot of money on those platforms. And again, a lot of what they work on is something new. There's a lot of entertainment value, but there's a lot of gamification that goes on.
Yeah, and matter of fact, this is a really good segue, because I didn't mention this to you in our little pre-call, Adam. Because we ourselves are following trends, we ourselves drink our own Kool-Aid. We mix it and we taste it as well. One of the things that Spark Partners is going to start to do is we're going to start to have a TikTok channel. And there is a significant lack. So, we got Facebook, we have these more mature social media channels that some may argue are exhausted. And, TikTok is something that has been growing and has still a lot of fertile ground. So I just want to let people know that that's one of the things we're going to be working on, is the ability to do that. Also, Clubhouse. I don't know how much you've heard about Clubhouse, Adam, but it's starting to take on a little bit of some feverish growth. So we're going to be part of that as we go forward.
Guys like you and I could get on it, but then it migrated to where it was pretty much dominated by big names, and it was very tough for somebody like you and I to get on. I hope they're pulling that back and opening up the platform and making it easier for us. And I think we should reassure our podcast listeners that we probably will continue with podcasts. We intend to, and that it probably won't be me dancing on screen on those TikTok videos.
It won't be me either. Although, if you were to actually dance, I would definitely pay money for that.
Bringing us back around to the circle again. Why I'm pro Netflix. I'm not telling people go buy the stock, but I'm saying I don't think it was overvalued at 700. I do think it's undervalued at 370. That's my opinion on the company and where it sits. And my opinion is based on their revenues. We've been saying this ever since we started the podcast. What do we look for in a company? Revenues and revenue growth. And we try to identify the trends that you can jump on, that you can maintain revenue growth over a long time. When your growth stalls, you're in a deep pickle and you're not likely to get out of it. It's really problematic. Yep. And so we're constantly talking about trends, so that we say, don't get stuck managing your business. Use trends to push you to the next level of revenue performance. And in this case, we've walked through an analysis of Netflix where we said the revenues have not stalled, the revenues are strong, they're doing things to add more revenue, and then we got to the point of gamification. That's the big trend that they've announced they're going to 6 months ago, and they're moving themselves that direction. So when I put those numbers together, I look through the revenue growth, I look at all the products that they have for sale, I look at how the market itself is expanding. There's still the gorilla in the market at 45% of the total market. They're expanding the content they're making, and they're going into gamification. I think people are going to look back in the future, and I don't know if it's 6 months or if it's a year or a year and a half. People are going to look back saying, wow, that company was undervalued at $370 a share.
For sure. And another good segue. So we had one of these last year that was very popular. We're going to have another live webinar. It's happening on April 7th, and it's called Growth Takes Grit. So this is a whole understanding of what growth requires, moving outside of your comfort zone. This is a topic that I talk with folks all the time, and I know you do as well, Adam, that comfort is what kind of holds you back. If you're in that cushy executive job, with the golden handcuffs, it's going to be hard for you to start a new endeavor unless you've got a good handle on your comfort level, right? You're going to be uncomfortable. So the growth takes grit. It's going to be Adam and I talking with lots of entrepreneurs, lots of business owners. It will likely be moderated by Sydney King of Spark on the Street, and she's going to help us to really look at I think in that domain, Adam, I'll be more the sales and marketing side. You'll be more the strategy and innovation side. And it's going to be an hour long. We're going to make this one a long one. I think the last one was only 30 minutes, but we've already got people that are very interested in it. And we'll be sending out some information here to our listening populace.
So we'll do that April 7th.
Yep, April
Do we
7th.
have a time? Do we nail down the time yet for people?
It will likely be 11 a.m. on Pacific Mountain Time right now. So we're the same time zone, Arizona and California. And so it will allow the people in the West Coast to maybe jump on it during their lunch hour. And the folks in Central and East can do the other side, basically hop on the other side of their lunch hour. We want to make this accessible. We've had some thoughts about doing it in the late evening, but people are going home, they're tired, and so forth. So I think 11 o'clock is a good time.
Well, it's a business-oriented event, and I don't think it's taking anything away from an employer, nor is it taking anything away from your job if you spend an hour with us on this. And so 11 a.m. Pacific time, which is 1 o'clock in the Central Time Zone, and it's 2 o'clock in the Eastern Time Zone. And I hope people can join us and participate in this live event. The last one, as you said, did pretty well. We did that one in the evening because we were a little concerned about people coming away from their work, but I think we're getting a lot more confident now that if the boss walks in and sees what you're up to, I think you'll feel good about it. And if you're taking away from your working day, I think you'll feel good about it at the end of it as well.
Yep.
It doesn't cost anything. So again, we'll sum it up. The number one thing we look for is revenues, and that's what we're chasing all the time. And we hope that every one of these sessions, people walk away with a sense of how they're going to get grow their revenues. And if you're stuck, go buy our workbook because our masterclass will get you unstuck and get you moving again.
Because if you're not growing, you're
dying.
Exactly. Always amazing time, Adam, to spend with you here on the podcast, and looking forward to next time. Of course, I'm really excited about this event in a couple weeks. It's going to be amazing. So with that, Adam, take care.
Thank you.
Cheers.